Good day, ladies and gentlemen, and welcome to our webinar. And today we're going to be learning about oscillators. Because oscillators are very important in your trading. Now, oscillators are a part of technical analysis, and they're also under the group of technical indicators. But oscillators have unique features to themselves, and we should know exactly how to use these technical analysis tools. Now, oscillators are one of the most interesting groupings of technical indicators. They are designed to signal overbought and oversold limits. Now, we're going to talk about that a bit more in a second because too many people confuse overbought with sell and oversold with buy. Okay. But we'll talk about that in a bit. Oscillators are a family of indices or indicators that go beyond the mathematics. They focus on one important thing, and that is momentum, or more specifically, the changing momentum. But before we delve into which oscillators are best to use and how, let me save you some unnecessary pain. Let me tell you first about what oscillators aren't. Some traders believe that oscillators are some important or some sort of magic index or indicator. Rest assured when I tell you they are not. Oscillators' main use is not to tell you whether to buy or sell. Rather, they alert you to when it might be a good time to execute a buy or a sell strategy. And that's a very big difference. See, a market that becomes overbought can remain overbought for quite some time, and then it can ease back down and just continue its uptrend. A market that's oversold can remain oversold. Imagine if you're looking at momentum and you shoot a rocket up in the sky or firework rocket up in the sky. It's going to go up and up and up and up and up, and so is your momentum indicator or your oscillator. At some point, that rocket's going to start losing its push, its momentum, and is going to slow down. But that doesn't mean it's going to fall back to earth. We know eventually it will. But it's just slowing its momentum. It's getting to the point where it might not continue on, or we know it's getting to the point it might not continue forward. Now, that rocket could ease back down in momentum, and all of a sudden the sun gets glaring brighter, the air gets hotter, the breeze gets stronger, and it continues to carry that rocket upwards. Still, as it loses momentum, it will fall to earth, but we just don't know when. And we don't know at what layer at that point it's going to hit that next heat wave and be able to carry itself up just for a wee little bit. So there is a difference. It's telling you that it's time to prepare, get ready for, but not to do anything. So those who attempt to use oscillators as an ultimate buy and sell signal should be ready to learn a tough lesson. Those that will use it to fine-tune their timing, however, will find oscillators a very powerful tool. Indicators are the most useful tool of technical analysis. They define precise moments to buy or sell. In financial technical analysis, is a lot of different indicators are used, but a majority of them double each other since they signal the same upcoming event. And this is what we call duplicity. We never want to pick a range or a group of oscillators or indicators that just tell us over and over with the same thing. There are many groups. So we have momentum indicators, trend indicators, volume indicators, volatility indicators, and of course momentum indicators. And under the classification of momentum indicators, and then under that classification becomes oscillators. And then down below that we get to bounded oscillators. So a technical indicator that shows momentum can be done in many different fashions. The ones that look like they are radio waves bouncing up and down, up and down, up and down. Remember how you used to see in the old World War II movies the spy using that radio oscillator to tune its frequency, and you could see those frequencies. Or remember the show, I'm going to tell you how old, The Outer Limits, in the whole beginning was, that's an oscillator. Okay. Then a bounded oscillator goes one step farther. A bounded oscillator always stays within a numeric range. No matter how it's calculated, no matter what the market does, always stays in this range of 0 to 100. So Forex oscillators show us the moments when the Forex market reaches its limit in any direction and opposite corrections of the trend become probable. When a price goes up, analysts say that the market is overbought. This simply means the price will stay stable or even slide down for some time because traders are willing to fix their profits. And during negative corrections, when new traders are entering the market, prices will rise. Respectively, oversold markets mean the exact opposite. Now, there's an important element to oscillators analysis, which is very, very important. Oscillators are used not only to discover overbought and oversold conditions, but to foresee breaking points in the price movement. Now, some of them are mathematical transformations of price on a graph, and their lines usually move in the same direction as the price. When the lines start to move apart, an analyst considers that the trend is losing its momentum. Oscillators are especially useful for that. So analysts, right now we haven't started talking about any particular oscillator, but most of you probably know the most popular ones. Can anybody name them? Well, two of the most popular Forex and even cryptocurrency technical indicators also happen to be oscillators, and they go one step farther. They also become bounded oscillators. And these are, I hear it, RSI, Relative Strength Index, and Stochastics. They are the most popular bounded oscillators. Outside of these two bounded oscillators, the next one that goes after that is MACD, which isn't a bounded oscillator, but is a very popular indicator. Now, an oscillator is any object or data that moves back and forth between 2 points. In other words, I was explaining to you like the radio waves. In other words, if an item is going to always fall somewhere between point A and point B, think of it when it hits the oscillating switch of your electric fan. So we have the stochastics, parabolic SARs, relative strength index. They're all oscillators. Each of these indicators is designed to signal a possible reversal. So what these indicators do is they will signal when the market is overbought or oversold, and especially to the extremes. And a momentum oscillator can help you distinguish between reversals and just fluctuations. So as I mentioned, MACD is one of the most popular indicators. It is not a bounded indicator. MACD is placed on the bottom of your charts, and it consists of several different lines. We have the MACD line, the MACD trigger line. When one line below crosses the other one, and they're using different formulas, they actually give you a transaction signal. But besides that, it also uses a histogram, and it will show us overbought and oversold conditions. So MACD gives us many pieces of information. Okay, and it is one of the most popular indicators in the marketplace. Then, as I mentioned, stochastics. Stochastics uses what we call a %K line and a %D line. It's again placed below the chart. And these are two different mathematical formulas, one based on the other, but when each one crosses each other, they start to tell us when the market is possibly overbought or oversold. Okay. Because stochastics is a bounded oscillator, no matter what happens in the marketplace, the mathematical formula for stochastics will always fall between 0 and 100. So it's bounded between those numbers, and then we have a barrier. The most popular barrier for stochastics is 75-25. Anything over 75 up to the 100 is considered an overbought signal. Anything below the 25 to the 0 is considered an oversold signal. Now in the middle of that we have a 50 line. So we can take a look at where these lines are going and whether they're breaking above 50 or below 50, and then when they break out into the overbought. And a lot of times we'll see them break into the overbought zone and then fall back into the regular zone and then push back out. But it tells us a way to read the markets and price action. So one's called a slow stochastics, and it gives us a very clear signal. Stochastics is a simple momentum oscillator developed by George Lane. There are multiple variations for stochastics, but we'll stick with the slow stochastics. Okay. So momentum shifts direction when the two stochastic lines cross. Therefore, a trader takes a signal in the direction of the cross when the blue line crosses the red line, which are the calculations below of the K and the D. Okay. Naturally, a trader won't want to take every signal. So we have our overbought zone and our oversold zone, but we have to learn how to read them in these ranges, because you see here the asset pushed way into the overbought zone, but fell back down, stayed above the 50, and then tried to push back up. And look at the price action. It gained momentum also, but when it couldn't break out to the overbought, it lost its momentum and fell down. So we can see how interpretations can be used. We can also use the filter on trades on higher time frames. We can, pop over to say we trade on a 15-minute chart, but we can pop over and look at our stochastics on a 1-hour chart. Then we have another one, which I don't know that much about because I don't use it. It's called average true range. But it is a momentum oscillator and will oscillate below on your charts. And then we have the awesome oscillator, which again is another bounded oscillator. And so there's a whole variety of these. But we have technical indicators, and simply an indicator indicates. It's an interpreter of the market. We then go from there to oscillators, which show us shifts in momentum and speed of the market. And from there we go to bounded oscillators, which help tell us where the trend might be going and give us trading opportunities and warnings. So thank you very much for joining us. I hope you learned a little bit, and I hope we will be able to teach you more. We have all kinds of classes in technical indicators. We have full classes on all the different oscillators, an hour class on each one of them. And then we have classes and the breakdown of all the different types of indicators and what categories they fit. And then how to use them in your everyday and how to trading and how to build strategies around them. So please join us for our other classes.